Welcome to the Real Estate of Things podcast. I'm your host, Dalton Elliott. John Curry, thank you so much for joining.
Oh, no worries. Pleasure to be on here.
It is great to have you. I met you over the summer down at a conference in South Beach, certainly worse places to be. And as the cold weather comes upon us, I miss the warm embrace of South Florida. You are the co-founder and CEO of Setanta Development Capital, really a residential development capital firm based in Charlotte, North Carolina. Did I nail the name Setanta?
You did, Setanta. I tried to pick a name that was Irish, as you can sort of tell from the accent, not a native. But also try to get something that Americans can actually pronounce. So we've had a few people calling us Santana, which sadly not a legendary guitarist, but Setanta, you nailed it.
I mean, he would be a good addition at the company Christmas party, though. Santana comes to play at the Setanta Christmas party.
Absolutely. We get sort of Black Magic Woman going there. It'll be perfect. And I guess obviously finish with smooth, so it'll be something for everybody.
We have just make sure I get an invite. This is an idea in the making. Especially in the age of tech companies and startups, I feel like I always run across awful sounding names with ridiculous stories, but your firm is an exception. I like the name. It's a cool sounding name, but there's also a legitimately interesting story behind it. I did some Wikipedia digging. Am I right that the origin is an Irish warrior?
Yes. So Setanta is the sort of the birth name given to an Irish folk hero. So it's a story called the Táin, the cattle raid of Cooley, and it's a couple of thousand years old. So it's the same as sort of the Odyssey around that same sort of time, and it's a story that gets told. So, for example, as I said, I'm from Ireland originally. My grandfather used to tell the story. And we'd sort of gather around, at a fire down at the local pub, Kluski's. And, he would tell it over like 4 or 5 nights, and, never the same. The story always varied, but it always had sort of key elements. And one of them is the story of this child, sort of the Achilles, sort of born with supernatural powers and strength. And, it's the story of how Setanta then becomes Cuchulainn, which is our, the lead hero in the story. So it's it's a fascinating story where it sort of overlapped with what we do. Is my co-founder, Robert Davenport, who's sort of a lot of the brains behind of what we do. We came together to form this platform, and I was looking for something that had a Irish name. And I like the name Setanta, and I like that story. And then the other main principal character in that story is Queen Maeve, and Rob's youngest daughter is named Maeve. And being opportunistic, I was like, you know what, we could call it Setanta, and it'll be Irish for me and Maeve for you, and sort of kill two birds. So I took advantage of Rob's goodwill to get an Irish name for our company.
I love it. So let's dive right into it. You and I chatted a little bit prior, and I have kind of a genuine knowledge gap in a lot of this. I think, I kind of cut my teeth in the private lending space, building out a mortgage broker program for Lima One Capital. And every once in a while, we would get a deal that would come in the door that would just be completely outside of our box that we couldn't do anything with, just not something we touched. We do new construction, right? Ground up, kind of foundation up, the vertical piece of it. But what was always crazy to me was how hard it was to find a financing option for people who came to us. We're like, hey, we're good if you have property that is fully platted, utilities are run, everything's good to go, it's pristine. Now we need to go up, need to actually build the structure. Everything before that, it seemed like there was a financing dead zone. I would talk with some folks who had been in the space for double-digit years. Hey, do you have an outlet for this? Do you know somebody in Atlanta, in Southern California? Every market, it was kind of the same. It was like, we know that this gets financed somehow because people aren't doing all this cash, but we don't really know anybody who does it. So I give that backstory to say, in my mind, the picture of foundation up, I understand, I know it well, but everything before that is kind of a black mystery box. So I guess start off, enlighten me. Why is it such a unicorn? Why is land A&D such a unicorn?
Well, it's an excellent question, and the short answer is it shouldn't be. But it's the often told joke in our industry is that land is a 4-letter word, and it just scares people. And it scares people because of a couple of things, and we can't discount '07, '08. And I'll try and be short, but I could go on and on about this as our employees can tell you I do on a daily basis. But '07, '08 is one of the greatest misremembered crises. It's sort of seen as we overdeveloped land, we overbuilt homes, which we did, but that's what our industry does. And I'll let you in on a little secret. We're going to do it again. We will overbuild. We always overbuild. We've overbuilt in the 80s, in the 90s, in the 90s, and we haven't overbuilt yet only because of the sort of misremembering of '07, '08, but that's normal. What harmed things in '07, '08 was Wall Street and sort of the financial instruments that were used there. So what you ended up having was this credit crunch that just, both led to a huge bubble and sort of fed into it, but then also through various administrations and various policies just decimated the industry, just hollowed out the developer underclass. So that's a very large part of it. But then there's always been traditional skepticism towards land, and the part that makes me laugh is it's very it's simple to get. There's plenty of fix and flip lenders, as you guys know well. Obviously, mm-hmm. one of the leading groups in both that and vertical, but there's a lot of competition, and there's if you actually have a finished lot, there's a lot of competition for getting that vertical side of things. And when you sort of pivot into build for rent, there's lots and lots of capital for stabilized homes. And on the for sale side, mortgage rates, while they're ticking up slightly, are still at levels, unbelievably low levels, compared to historic norms. So every aspect of housing has low rates, lots of competition. And then the most important part of housing is land. You cannot build without land. And yet somehow we're the sort of the ugly stepchild that nobody really wants to address. And when I push back on people, the number one thing I get told is, well, land, it's very illiquid. If nobody wants to buy it, it's very hard to do anything with it. And the two sort of thoughts to that is, one, anything is illiquid if nobody wants to buy it. So it doesn't matter what asset class you have. If nobody wants to buy it, it's illiquid. But secondly, compared to a office building that could be empty or a retail strip mall that could be empty, land is land, and mm-hmm. I can have a picnic on it. I can graze animals on it. I can grow something on it. I can put in for planning for a different type of use. So what's bizarre is I sort of see what people say about, land, it's illiquid and there's nothing else you can do with it. And I'm like, it's no more illiquid than anything else. And anything, the maintenance of it and the many different uses I can use for it means that, quite frankly, I'd rather have $100 million invested in land than I would in office. And in fact, I do.
Yeah, as you're describing this to me, I have like a left brain, right brain thing going on. Part of me, like 7 years in this space, like what you're saying rationally makes sense. I understand it. And I'm like, yeah, of course, land is the basis of everything, no matter what type of property, like structure sits on top of it, or maybe nothing sits on top of it. Maybe it's farmland, like you said. That's the one side. And it's like, it makes complete sense. And then the other side is this deep, dark Pandora's box of scaredness. And like, I don't know, this land, I don't know. It's just that like conditioned in the industry, like you said, to be this, to steal your phrase, like a scary little stepchild that nobody wants to touch. So how do you break into it? How do you convince, and I'm not entirely, how do you start a business on the land development side of the fence? This ultra niche, people see it and run.
Yeah, no, that's a really good question. And that's actually the most important thing to understand about our platform is to understand our origins. And as I said, my co-founder, um, Rob Davenport, is instrumental in that story. So I sort of, I was in Ireland and I was thinking, what did America need more of? So became a lawyer and, was over here doing, real estate transactions. And in '07, '08, mainly commercial, but, as we all did, we sort of pivoted to workout, opportunity. And that led to a lot of land foreclosures, working at that, as well as sort of, opportunities that came from that. And my partner Rob, he was more on the hands-on development, working for developers, and then obviously through '07, '08, also sort of pivoted to helping banks, helping equity shops, and we overlapped at a private equity group, and that's very important because what it meant was we were both at a private equity group that at a time when there was very little money in this space that was betting on the fact that land development and home building was here to stay, and that there was a place for it, and that we could understand it. So we learned a lot of stuff there. And on the equity side, as the attorney, I was tasked with telling our sponsors, because the equity doesn't like the share, right? So the equity, we want to put out as much money as possible and as little debt on it. So I would get loan applications from our borrowers who'd say, well, what if we put like 30% on or 40% on anything so that we don't have to pay our equity, 20, 30% returns. Mm-hmm. And, I was told in a non-adversarial way, it's like, let's just see if we could just not do this. And it was very easy to say no to. I would contact the borrowers going, have you read this term sheet? These terms are awful. The rate's too high. If you sneeze incorrectly, you lose the land. Like it's the hardest of hard money. And that process did two things for us. One is we were already doing 90, 95% of a deal, sometimes even 100% for a sponsor that this was maybe our fourth or fifth deal with them. So the idea of going that high up the cost chart didn't scare us. The second thing was I was looking around and seeing that there was very, very little good competition. There are very good lenders in our space, but there's not enough of them. And I realized that if you could go out there and carve out a little niche for yourself, you would have people falling over themselves to give you their business. And again, you still have to earn it and you still have to work hard for it. But that's what we discovered. So when we created Setanta and a debt platform for developers, there were two things that we wanted to make sure that we were answering correctly. The first one was, what would we, myself and Rob, what would we have said yes to when we were on the development side? So making sure that I don't ever ask somebody to do something that I wouldn't do. Make sure the loan documents are fair, the whole process is fair. So simple things like if somebody says they have a 2-year project, we give them a 3-year loan. If they say the first lot take is going to occur in February, that's great. I trust you. I believe you. Guaranteed it will. However, let's not make it a default until maybe October, November. Like let's give ourselves some padding because the next deal that has the first lot take occur as scheduled will be the first one. So that's the first part of this is to what would we have said yes to, and then the second part, and this is not it sounds like it's a joke, but because we had been in this industry, we'd been part of a joint venture that had put out over $1 billion in this space. We were able to go through people across the country in different markets and ask them a very simple question. What do you hate most about your lender? And as long as it didn't impact our security, at least in my opinion, we would do it. And, there's some of those are simple things like making sure we fund within 10 days. Some of those are more fundamental and people think we're crazy, but we just don't have interest reserves. We don't believe that an interest reserve, does any benefit other than put us at odds with our borrower as to how long a project's going to take. We also try to limit our fees. We'll charge, typically we'll charge a point and that's it. We don't have any exit fees, any annual fees, any servicing fees, any draw fees. And just simple things like that. So why did we get into this space? Well, we kind of fell into it through where residential development happened in '07, '08. So the fact that myself and Rob came through that was very important. But also we just looked around and we saw that this is an area that the market has and continues to misprice the risk. So as long as the big institutions are not wanting to play in this space, we're happy to reap whatever we can.
Yeah, you kind of built up a lot of your business around one of my favorite questions in my day job as director of sales and customer experience. And I feel like everybody likes to ask, what do you love about us? What do you love about us? But to me, the most important question is, what do you hate?
Yep.
What just makes you pull your hair and teeth out? Get absolutely frustrated, and then that's where you start. And if you start overcoming those, and you whipped off a million of them, that's how you create a customer experience and a product that's your competitive advantage, right? You fixed all of the problems in that space in your ecosystem. It's going to speak for itself, right?
Oh, absolutely. And sometimes we forget that hate is as strong as an emotion, perhaps even stronger than love. And let's be fair and be frank, it's very few borrowers who love their lender. It's very hard to get
Right.
to get someone to love you when you're charging them double digits on their loans, but it's very easy to get them to hate you. And I think that's so if we're looking at those strong emotions, given that it's so easy to get the hate one going, if you can steer from that, or and I do this, I'm very cynical, but know what people hate about our competitors, and then specifically lean into that on our phone calls or our meetings. Well, we actually don't do this, and oh, did they do that? Oh yeah, but no, well, we don't. So like little things like that then will steer people in your general direction.
Yeah, a big fan of that line of thinking. So I started my career as an underwriter on the long-term debt side, but everything I looked at always had a property sitting on top of it. We have at Lima One new construction financing for SFR, but again, it's not looking into a forest of trees and saying one day this land will be ready to develop on top of. We're way past that point. So can you kind of walk me through, I guess, is there really a material difference whenever you're valuing, a $250,000 SFR that's already built up, that just got finished, versus attractive land that is completely virgin, untouched, and you're going to go build 250 homes on it? So is there a material difference? And if so, what are the differences when you're looking at it from a valuation standpoint?
Well, yeah. So there's certainly there's differences, and what we sort of see is where is the risk, and
Mm-hmm.
we sort of again look at it perversely. We sort of look at it the opposite way. So whereas everybody sees land development as being the more riskier option,
Mm-hmm.
let's sort of take sort of an example of 250 finished homes and as you're saying, a land to develop 250.
Mm-hmm.
I would argue there's a different, at least a 5 year different risk cycle. So on those 250 homes that you're buying, you're putting out the full amount on that day one, and you're fully pot committed, and hopefully your assumptions are correct. If 2 years in, the market fundamentally evaporates or changes, or if some of your assumptions were hideously wrong, well, you're stuck with that mistake. And yes, maybe you can try and get out of it, but you were pot committed, you put your full money in, and now you're sort of riding out the consequences. Well, let's take the exact same example with us. We've bought the land. So maybe to develop those finished lots for 250 homes, the land price may be $2 million. And the entire project is going to cost us, 15 million. So 2 million of acquisition, maybe another million of getting it there, and then 12 million of sort of development over phases. Well, if the market bottoms out in 2 years' time, I don't have my full amount in there. I've only got whatever I've developed over that period of time, and I can maybe pivot into rental, pivot into sale. I can do something different with it. I can put the project in mothballs and see what I can do with it. So when we look at that, we're looking at that opportunity and saying, okay, yes, there is risk that a builder isn't going to buy these lots, and there's risk
Mm-hmm.
that the home price, to build these homes is going to be astronomically expensive. But those are all risks that we can sort of wait out over time. But if there's a fundamental nobody wants this product anymore. Somehow we've invented a new way of living that we don't need homes. Then it's we can still pivot into something different and put the project in mothballs, which you can't do when you have single family rentals already finished. So interestingly, whereas that product is considered less risky, so it's getting sort of mid single digit returns on its loans, and ours are getting almost double that. I would argue, and this is how we built our thesis, is that I'm actually taking less risk. I'm allowing myself to be able to pivot and change direction at any time. And again, that's, some people will hear this and say, this guy's absolutely crazy. It's land. What is he doing? There's only one thing you can do with land, and that's build on it. But as I've already mentioned, there's other things you can do. And again, the key thing to remember on a $15 million development, your projected peak is probably only going to be $7 to $8 million. Whereas on a $15 million property acquisition, you've got $15 million out the door day one.
That's a compelling argument.
Yeah, maybe you should stop doing this. I don't want other people to enter our space. So forget everything I've said. It's very, very risky, and nobody else should do it.
We'll keep it secret. I think it's just my mom and my sister and my wife who listen, so we're good, John. No worries, no worries. So that makes sense on the valuation perspective and the risk view. I'm quickly aligning to your side of the fence. The ability to pivot there is something that you don't have whenever you got a bunch of homes on top. Supply chain issues. Let's touch on that 8,000-pound gorilla. I just got a mountain bike. It took over a year to get a bicycle, effectively. It doesn't matter what you're trying to get right now. Get in line, and it's going to be a minute. I have a friend who got a Toyota Tacoma. It took 2 months to get it in the door. Everything, no matter how big or small, is taking forever. How has that affected your business? How has it affected the loans that you have outstanding? What are you seeing?
Yeah, so it's one of the benefits of what we do, right, is that we're taking raw land, though for our platform we're required to be entitled. But if you're an amateur and you're looking at a land that is unentitled and a land that's entitled, looks the exact same. So we're taking a big green field and we're putting in the infrastructure. So not to say that supply issues don't impact what we do, because there's certain materials, minerals that are needed, and obviously as we're putting in asphalt or concrete, depending on the state, and as we're doing grading, or we have machines that are necessary to do that work. But we don't have the same issues that home building has, because we're not as material intensive as that is. For example, there's very little lumber that's needed in developing lots. However, it would be foolish to say that means that the supply issue doesn't in fact impact us at all, because it absolutely does. It impacts when builders want to buy their lots, and that's builders are in a bind right now, where they're trying to decide, do they take advantage of this market, which means sort of build as quickly as possible, but that means maybe overpaying for materials, which means that your margins are a little bit lower, but the velocity is higher. Or instead, are we trying to space that out? And if you're spacing it out, what does that do to lot takes that you've committed to taking? If you're supposed to be taking 15 a quarter, 30 a quarter, but instead you only want to take 5 or 10. So it does have the potential to impact us. Right now, we haven't seen it impacting us because either our projects are too early in, which is a benefit, again, of land development, which is the loans we close today are delivering lots in a year's time. Fingers crossed, a lot of these supply issues are resolved by then, or at least there's a new solution to them, or an alternative to it. So that's, again, one of the benefits to the length of time it takes for us to do stuff. But we do anticipate that there will be a little bit of pushback from builders, and that's just something we're going to have to work with to understand it. Like, if they're still going to take 30 lots, but instead of taking 30 in March, they want to take 10 in March, 10 in April, and 10 in May, we just need to make that decision. Does that make more sense? And in general, both with our borrowers and with the builders, we want to be good partners. So we're not looking to, the benefit of coming through the development world that myself and Rob came through is we absolutely, positively do not want this land back. We do not want to be developers. We're developers who lend. We're not banks who are trying to understand development. But that also means that we're not so gung ho that we're like, oh great, we'll just foreclose and double our profit on it. No, we're going to try everything we can to make it work with our borrowers, because we really, really, really do not want to become developers again.
That's a sign, one of the good signs of a good, honest lender, which is like I want to do this project only if it makes sense, only if it seems like you're going to be successful, because I do not want to take on projects. I don't want to have to, turn my accountants into project managers and give them hard hats and boots and send them out and about to go manage across the country.
Yeah, it's the benefit of knowing what that actually entails. So because we know what's involved in doing it, and it's good, right? So it means that we know we can do it. It means that if we have to take over a project, if we have to take it in internally, we can do that without farming it out. We're not running around panicking. But again, to your point, like we're very straightforward. The ideal scenario for us is we give you money, you give us that money back plus interest. We give it to you again for another project, rinse, repeat. That is our dream scenario.
I like it. We just have to figure out this is not your company thing. This is like the horizontal development industry. They didn't have a good PR guy. All right. Like now rehabs are on HGTV. I was in Charlotte, your neck of the woods over the weekend, and just flipping through at the hotel late at night, and a rehab show was on. Absolutely passed by. I'm like, that's the day job. I don't want to watch that when I'm at night. How do we get horizontal development on HGTV, TLC, sexy it up a bit?
Listen, I can tell you the benefit of being Irish is we know the value of land. So there's many of a family feud that has been fought over land. So land was always sexy in Ireland. It was I'm the son of a farmer and the son of a daughter of a farmer, and my mother would constantly say, they're not making any more of it, John. So it's all about the scarcity of it, and the ability to have it. So there's a wonderful play. It's an okay movie, but it's a wonderful play called The Field, with Richard Harris, who most people now would know as the original Dumbledore, but for some of us older, just a genius of an actor. But one of his loves, it's all about a little field in Kerry, and he's renting it, and the owner of the field wants to sell it, and a big burly obnoxious American comes in and overpays for it, and the rest of the field the rest of the movie is the disastrous consequences that comes of that. So if Netflix wants to give me a couple of $1 million, I can definitely find a way of making land sexy. It's in our blood.
We'll put in a call to Reed. We'll get you on the production docket. You said something at the very beginning that I want to unpack a little bit, and perhaps there's a history lesson in there for me, which is that we always overbuild. You said in the 80s and the 90s and the 2000s. Walk me through that. That kind of maybe I don't have enough history knowledge on the real estate space to make any sense of that it's a cyclical thing, it sounds like.
Yeah, residential development is probably the most cyclical of investments, and it just has a sort of tried and tested. This keeps happening, and it doesn't just happen in America. Ireland has gone through several booms. The United Kingdom has gone through several booms. Japan never really recovered from their boom, and right now we're seeing what's happening in China, which is going to play havoc with the economy over the next 2-3 years in an indirect way. But it's all predicated on the same thing, which is we all need a place to live, right? We have not yet decided that we're just going to roll into sort of wardrobes and that's where we're going to sleep. We want to have a place to live, and certainly in a lot of countries and cultures, specifically America, and you've got that. I want to have my own home. I want to be able to do things. I want to have the freedom. That owning a home or renting a larger unit affords me. So that's something that's baked into the culture as well. But when you combine that with the fact that it costs a lot to build, it costs and that values inherently increase for a lot of people, your home is going to be the first entryway into actually earning equity, investing, making a return on your investments. Maybe you move to a second home, but you now rented out your first home. It's the gateway drug for the mom and pop investors around there. So, but what that then leads into is sort of, as you sort of pointed out, it then leads to the TV shows around it, the culture around it, the talking about it, and everybody wants to get in. Everybody wants to, see what they're doing, and it's just a traditional bubble. There's nothing necessarily unique about it, except for, unlike maybe stock market bubbles or tulip bubbles, in historical times, everybody has some connection to a home. Either they're renting it, they're owning it, their parents were living it. Everyone has a connection to a home. So it makes it more pervasive, and it makes you feel wealthier when you have one and you have your neighbors, and everyone's values are increasing. So that gives a level of intoxication. And we always think that this time is different. But I remember in 08, 09, saying to the bankers in the space, we will never make the same mistake for at least 10 years. And that's sort of the way I like to think of it, is we'll never make the same mistake until we do. We'll find a new mistake to make. But yeah, absolutely. You're looking at 83, 84, housing oversupply coupled with the interest rate, madness. Obviously, the 70s didn't have as much of it. Then you had, the savings and loan crisis of the early 90s. You had, and then what was interesting is in 2000, 2001, you had the stock market fall, which should have led to sort of a recession, but didn't, because all that money sort of pivoted instead into residential, which then led to a much, much bigger bubble in sort of 05, 06, 07, that then, obviously peaked with 06 with the Bear Stearns Fund collapsing, and then 07 with, with sort of, really the, things hitting the fan, then 08 with Lehman. So, we've got just sort of that history. And I think the reason we haven't seen that now is because this, from 07 pricing, homes that sold in 07 really only started getting their value back in 2019, 2020. That's an awful long recovery. Very, very unusual. Variety of different factors that came into it. Mainly one being that there wasn't just enough developers or land supply. But what that ends up meaning is that we haven't hit it yet. And I do still think we're 5 or 6 years away from hitting it, but we're human. We are going to overbuild. We're going to convince ourselves that this time it's different. And, the important thing for us is, I like to say that I've got, principles that are, in ink, not pencil, so we sort of have our little canaries, and when those, stop singing, I hope that we have the discipline to take our chips off the table. And maybe we're wrong, but this industry has shown us that, if left to our own devices, this will continue to cause problems. And I guess to give you a more clean-cut, clearer answer is, house prices are gone up 19% year on year. Mm-hmm. Rents are going up 10 to 20% year on year per market. Now, if you had been underwriting to the 2018 model and you keep to that, great. This is all gravy. And then when things come back to normal, you're doing fine. Mm-hmm. But what you'll find, there's going to be a certain submarket there that's saying, well, what if this actually is the new normal? What if we can actually get these rents this time? What if entry-level housing in Charlotte should be 450 to 500,000? What if entry-level in Greenville, where you guys are, and we do a lot of work, what if entry-level there really is 400, 450? And that becomes your baseline, and that's where you put all your money in. Well, when the normal comes, that's when, as the famous Warren Buffett, comment is, that when the tide goes out, that's when you discover, who's still wearing their bathing shorts. So, it's that's what we see, is there is going to be overbuild, we believe, based on, what's happened over the last 40, 50 years.
Yeah, that makes sense, especially when you lay it out over that historical timeline, and it's almost to the clock that it seems to happen. So talk a little bit about Setanta, right? Like, what does y'all's strike zone look like? What's the beautiful center of strike zone with the World Series upon us? The beautiful center of strike zone deal look like?
So you're talking about that game Rounders, right? That's with the snake in the ball, yeah. Now it's we know that there's a gap for lenders in the A&D space. I think the hardest thing is for us is to try and stay disciplined. what we want to do is we want to be in the markets where people are moving to, and we want to be delivering the homes that people need. So that's entry level, next stage, perhaps a stage above that. We don't want to be in the luxury home area. We don't want to be in the custom home area. Not because we don't think there's a need for that. In fact, I think there's a huge need for that. And I think there's a huge gap in the sort of executive luxury rental market. As anyone who's ever tried to rent a home, for 3,000 square feet or more in any market can tell you there's a lack of that. So I'm not knocking that as a model. I think it's very real. But this is more of a philosophical thing. We want to be doing as much good as we can, and we want to be able to give people, as many people a start into home ownership as possible. And the best way of doing that is by being able to provide affordable housing. So it's the area that we want to be in. And again, there's a capitalist, greedy, selfish bent to that as well, which is, those are the areas that are less impacted by interest rates, because as some people drop out of buying it, others sort of come into it. So, it's not completely selfless, but at the same time, we do like to be in that area. And we do think that sort of fulfills a big ESG component as well of, sort of making sure that we're giving something back to sort of the society that's out there, and making sure that we're having a positive impact. As far as what, our strike zone, we'll do loans as low as 2 million. We recently, just last week, we closed the $73 million deal. Previously, we've closed a $40 million deal in the DC market. But we've also, and this is what I like about our platform, is, that the same week that we closed the $73 million deal in Greensboro, we closed an $11 million deal in Houston. This week, we're going to be closing a $3.5 million deal in North Carolina as well. So I like the fact that we're not only wanting to do the bigger deals, which everybody's chasing. We recognize that it's actually more difficult to get a $5 million loan than a $50 million loan. So we'll do as low as 2 from a land development. That typically is going to be a minimum of 18 to 20 units. And we like it to be contiguous. And then we don't really have a limit on what we can do, as long as it fits within what our borrowers are able to do. We want our borrowers to have some level of experience, but we also understand that 07, 08 wiped out a lot of experience in this space. So, you're by necessity going to have to work with younger developers, so we don't hold that against them. And, we're looking for people that we can do repeat business with. We don't do ROFOs or exclusivities, but we want to make sure that if we do a good job and we do what we say we're going to do, I want to know that I can get there's more business to get. And that, that's really our key point. And one of the things I'm most proud about is, we're on our 4th and 5th deal with some borrowers. We're actually, if the folks down in Charleston ever get certain plans approved for our borrowers, we'll be doing our 8th and 9th deal with certain borrowers. So, we love the fact that we're getting that repeat business, and it's, we want our land to be entitled. We want it to be under contract to a builder or to a build for rent or self-built if it's a private developer. And, what makes us different is we do 85% LTC, and that's where we start. We start at 85%. We're only going less than that if there's a big deposit, or if our borrowers, for whatever reason, have equity that they want to, to earn some more on, or they want to just keep the interest sort of down. But, by and large, we're starting at 85. And, where we, if you want to pivot into this, where, we know A&D very, very well. We like it. We've understood it. We're not scared by it. We had flirted with, did we want to sort of be in the vertical space? Because there is sort of a gap there, specifically for build for rent, where traditional banks who maybe were only financing 5 starts a month are now having understandable heartburn of doing 15 to 20 a month. So, understanding the velocity is important. So we flirted with that, but then we very quickly realized that we know A&D, and sort of the funny thing is, this was a conversation that sort of started us talking with Lima One, which is, all the things that you don't know about land development or scare you about land development or make you wary, we shared the exact same sentiment to vertical. And it was a wonderful conversation when I was talking with your colleague, Josh Craig, about, all of that stuff. And he's like, oh no, we understand that. It's the land part that we don't have anything to do with. So it quickly seemed that it would make sense that, to take advantage of this, if we could sort of team up with someone who knew the vertical side, to sort of complement our A&D side.
Yeah, I remember the first time Josh, my colleague, and I report up to Josh at Lima One. First time he mentioned, didn't mention by name. It was still early stage, but so we're talking to a land A&D company based out of Charlotte, and perked up because of everything you and I hashed out in this conversation here. Like, what a unicorn financing outfit, really. And one of the more beautiful symbiotic relationships of we specialize in something that you don't have an interest in because you specialize in something. The same is true on your end. You do what you do, you know it well. And it's something that just made sense from the get-go. It's one of those partnerships that you don't have to expend a lot of brain power seeing how it works and benefits everybody, and being able to provide an end-to-end financing solution of, hey, if you have land that's entitled and you need to go from A to B to then go from B to fully vertical, that option is out there, and that's one of the tougher things to piece together financing wise. I think arguably in the entire real estate investing sphere, at least in this country. So it is a beautiful thing, and it only helps that y'all are an hour and a half, 2 hours away from us. So some good southeastern headquartered outfits hashing it out.
Yeah, no, certainly. And what was great about it is it the response that we've heard from the market, the response we've heard from our own borrowers and from talking with your borrowers is really that it's not just that it's a one-stop shop, or as I like to say, it's a two-stop shop for one option. So you can talk to two different groups to get sort of a one facility. But what's great about it is, because we're experts in our area, we're not necessarily compromising on what we don't or do know, and not casting aspersions on any other groups, because I actually don't think that there's many or any that really can offer soup to nuts land acquisition to finished home and beyond, because obviously you guys also do on the rental side and stabilized financing as well. So there's very few people who do that, but we can bring our areas of expertise. So we can bring the expertise to the A&D side and then smoothly transition it behind the scenes to you guys, so you can sort of run with it on the vertical side. And the borrower is getting both the benefit of the of our experiences, but also actually our experiences, so that we're not you're not trying to work out, is this normal for A&D, or should I over course correct? And we're not taking undue risk on the vertical side, or similarly being too cautious because we don't know what's industry norm. So it's a very, very good fitting, and it sort of is natural. I do try to find, and it was great when I spoke to Josh. To find someone who sort of shares your values, has similar ideas that you have, but also that you can sort of have a true symbiotic relationship where you're not actually competing with each other really for anything at all. In this relationship, certainly not. And it goes back to when I was a kid. I sort of trained myself to eat the chocolate candies that other people didn't, because that meant that whenever I went to somebody's house, there was always an excess of the it was typically orange cream and coffee cream, but that's that's sort of my mindset. Is it goes back to why we're even doing land development. If I find something that nobody wants to do but I like, and then I can sort of team up with other people so that we can go through the whole tin together, it's a wonderful thing.
I love that. It reminds me of in college how I got into bourbon. Right, I realized that if you have beer in the fridge, that's just going to mystically disappear. Like, the fridge taxes the beer. Every day that goes by, there's less beer in the fridge. You're like, what? I drink, at college, drink a couple, and then 2 times as many are gone the next day. The mystical thing. But that bourbon would sit on the shelf and nobody would touch it. And it was an acquired taste for me. I don't know if there's anyone who drinks a bourbon and immediately is as a late, I don't know, we'll say 21, but in college and goes, oh, this is delicious stuff. It was definitely an acquired taste. And I remember we had a snowstorm down here. If we get 2 inches of snow, the state shuts down. Same thing with the college campus. And there were a couple of days that we were kind of confined more or less to the apartments, and just a plentiful supply of bourbon. Eventually, some people broke down and were like, "It's alcohol. We gotta drink it. We don't have any beer. We have no other options." So it became a scarcity thing. But I like the candy and bourbon corollary there.
Well, certainly. And if I can just say, obviously, I'm a big fan of bourbon, but I'm a bigger fan of Irish whiskey. And if you like bourbon, Irish whiskey is a natural progression. We don't have any of that. Well, there are some peaty Irish whiskeys, but we're very very much on the smooth side. Not at all like Scotch. I'm not a Scotch drinker. I do not like Scotch. Love Irish whiskey. If there are many brands, but Redbreast. If you can get yourself a good bottle of Redbreast at 12 or 21, it's well worth the investment. But again, I'm the unofficial whiskey ambassador, certainly in the Charlotte market. I'm always pushing on people, and typically after we've closed our second deal with you, a bottle of whiskey should be making its way to you at some point.
I love it, and if it is a bottle of Redbreast 12, it is incredible. I also not a Scotch fan, just don't like it. Bourbon, a friend of mine, a colleague here, I think he got gifted a bottle of Redbreast 12. And I was just naysaying it. I was like, this is non-American swill. There's no way this is good. And I love it. I always keep a bottle on rotation. Redbreast 12, I think, is a spectacular, if you like bourbon, maybe you don't like Scotch, you're looking to get a little to the other East Coast, then you can't get a better recommendation. The price point on Redbreast 12 is beautiful as well. A great value. One thing I hate about really hate, we're invoking those strong emotional words again, is how some bourbons over the last 6-7 years to date has become so hard to get a hold of. Things like Blanton's, you just go down the list, Eagle Rare, bottles that on the shelf, E.H. Taylor is another one of my favorites, that are in that 40 to 60 price range. They have higher tiers, but their base bourbons are not anything crazy, but impossible to get. We have a Total Wine near us, and you have to spend a bazillion on wine. So my wine spend gets me the chance to enter into a lottery to then win a bottle of one of 25 different ones, and fingers crossed. It's just become a nightmare to keep the particular bourbons in stock in the home.
No, it's ridiculous. And actually, I forgot that you guys have the benefit of not being in a regulated state like North Carolina, the great state of North Carolina. But if I can give you another recommendation, that you can get in Total Wine is Three Swallows. It's Powers Three Swallows. It's made by the exact same people who make Redbreast, so it's the exact same people. Sort of like the Blantons and where they're all sort of made out of the same Buffalo Trace distilleries, but made by the exact same people. Typically, a bottle will knock you back by $40. So Three Swallows Powers, it's about 40 to 45. And it's just as good. It's an Irish single pot still, so it is different than traditional whiskey. It's different than Jameson. It's a unique whiskey style that the Irish brought in when the English at the time that they were the colonial power. They brought in a tax on malted barley, really to impact on the Scots and the Irish, and the Scots being the Scots just rolled over and took it. Whereas the Irish, being more creative, decided, well, what if we did half malted, half unmalted, therefore only paying half the tax? And they experimented with it until they found something that tasted good, and that's what Redbreast is. So Redbreast is actually not like Scotch or bourbon at all. It's a half malt, half unmalted process.
Typical. The Irish trying to figure out how to evade taxes for hundreds of years.
No. I would say the Irish trying to deliver, good, affordable products, both in the 1800s to today.
There you go. That's the good PR spin to it. While we're on this topic, if you'll indulge, if you were confined to only being able to have one bottle on tap at your house from here till kingdom come of alcohol, what would it be? Mine is E.H. Taylor small batch. Like I just, the taste just hits all the points for me. I have some higher tier bourbon, if you would, but I think that's something I drank at just a particular time in my life a lot, and really it just hits the mark for me. What's yours if you only had to pick one?
So for me, I sort of, obviously I'll cheat and sort of pick two, but like one I've already mentioned, which is Redbreast 21, and I love that. Now, in Ireland, you can get that for about 140, 150 euro, about $175. For some bizarre reason, I don't know why, it's $300 to $400 in the United States. So it's a very, very good value at that price, not at the US price, but it's absolutely delicious. It's single pot still, and it has that sort of caramel, chocolate, toffee taste, which I am partial to. But if not Redbreast 21, I would go for the Middleton Barry Crockett. Again, similar single pot still. It's more of a blend of different age statements. So it can be as low as 12, as high as 30. And it's just blended to just an excellent sort of perfection. So if I'm stuck with that, and again, that's going to be a higher end bottle. If I have to pay for it myself, I'll probably go for the Powers, with the 40, 45 dollar bottle. But if somehow the whiskey gods are just reinstalling this every day, then the Barry Crockett would be the Middleton Barry Crockett would be the way to go.
I love it. Yeah, the who's footing the bill, that does have a way of swaying opinion one way or the other for sure. Yeah, you don't want to only have one option and it's a $400 bottle and that's all the swill you have in the house. Like exactly. Your problem, expensive habit. I can think of no better note to end on than alcohol. If people want to get in touch with you, it's setantadc.com. Is that right?
Yeah, so Setanta Development Capital. So the website is Setanta DC, D for dog, C for cats, .com. And, and myself and Rob are the two best people to get a hold of. We take sort of our borrowers very, seriously and importantly. So John, John, at setantadc.com. Rob, R-O-B, at setantadc.com. You'll get us and you'll get our attention. And, we've got a great team with us in Charlotte, and, we'll hand it off. But we certainly like to spend, those initial conversations with our borrowers and make sure it's a good fit. We've got the same philosophy. We'll turn down deals if we don't think that there's a long-term play here. We don't want to be somebody's, I was stuck, nobody else would answer my call, take it. If, we want someone who we can actually build a relationship with. But yeah, that's the best way to get a hold of us.
Beautiful. Hey, John, thank you so much for carving out some time to chat with me. I learned a ton, and I have a new shopping list for Total Wine this weekend.
Good stuff. An absolute pleasure. I've been listening to the other podcasts. I think it's been very, very interesting. It's a nice, diverse listening. I got, anywhere from sort of saving, Reg D to understanding that, favorite asset is the one that makes you money. So, it's been a very interesting, podcast series. I'm honored to be a part of it, and best luck with it, and continued good success.
You're far too kind. I greatly appreciate that, John. Thank you so much.
No worries. Absolute pleasure.